Hello and welcome to Business Today Television. You're watching Easynomics, and with me today on the MPC's latest moves, a wait and watch policy just after the election results, are some key economists, important economists from across India. Anubhuti Sahay, head South Asia Economics Research at Standard Chartered Bank. We have DK Joshi, Chief Economist at CRISIL, Aditi Nayar, Chief Economist at ICRA, and Nikhil Gupta, Chief Economist at MOFSL. Thank you very much for joining us. I want to go straight to Mr. Joshi. An unexciting policy, wait and watch, nothing much was expected. Did you pick up anything that was a surprise to you, Mr. Joshi?
Not at all. I mean, the central bank had, through its communication, set the market expectations right. I think it was a near consensus expectation that the rates will be on hold, because central bank has the policy space, or which it gets from very high growth, so it can pursue its monetary policy objective of aligning inflation to 4%. And since growth surprised on the upside, it became even more clear that now I think central bank is on that path, and this is their opportunity to actually bring the inflation down to, or at least align it to the 4% target. I think one interesting thing that happened was that now there are two members of the MPC. Earlier it was just one, who are veering towards softening of the policy stance. But the governor was pretty clear that the last leg of inflation is tough, not only in India but across the world, and so they are going to be focused on bringing inflation down.
Focused on bringing inflation down, and an elephant who is being a bit dogged before it goes fully into the forest, Aditi. But why is it important to ensure that the last of the elephant goes fully into the forest? Why is that very, very important at this stage?
Thanks, Siddharth. Well, certainly, I mean, the RBI and the MPC have waged a very strong war on containing inflation and on anchoring inflationary expectations. And the way that we have seen, over the last few quarters, there are various risks which keep popping back up onto the horizon. Whether it's related to the conventional ones for agriculture like monsoon, or the newer one like climate change and unexpected climatic incidents, geopolitical issues which keep popping up onto the radar, and crude oil prices which never seem to settle one way or another. So there are lots of risks, there's lots of things that can go wrong. And my sense is that even when we have this favorable monsoon forecast, I don't think it's a done deal that there will be no episodes that will create problems for food prices. So I think a little bit of wait and watch, to make sure that we don't end up having sporadic incidents of very heavy rainfall in the second half of the monsoon season, for example, which can also be pretty bad for the standing crops. So things like that still remain risks, and it's certainly good to keep a wait and watch, especially when growth is as high as what it is right now. There's no hurry to go in for rate cuts when you could end up with some inflation risk manifesting, which would end up upsetting the anchoring of inflationary expectations.
Anubhuti, is the RBI, the MPC, in some ways, without actually putting it in words, also saying that, the burden of trying to do something for food inflation is perhaps only on us now going forward, because a new government has come in, and perhaps due to the changed political realities, it will have to focus on consumption?
What you have mentioned makes a lot of sense, Siddharth. So I think if we look at the past monetary policy statements, they have been constantly reiterating that inflation below 5% or in the 4% handle is not just good enough. They want it to be aligned to the 4% medium-term target on a durable basis. We have to see how this statement evolves. First, after the monsoon performance is clearer to us, once they get a lot more clarity on food. And the other thing which I was a little surprised, there was no mention around it, was the upcoming budget presentation. As you very rightly mentioned, under the new coalition dynamics, it's highly probable that we will see more spend towards boosting transfer of purchasing power, which usually turns out to add to a little bit of inflationary pressure. So I think these are 2 points on which the RBI and the MPC would definitely like to get more clarity before they give a clearer indication on where rates are headed going forward. So I won't say that they're shifting the burden, but these are definitely two key monitorables in our view for us as well as the RBI to understand the inflationary risks going forward. There's yet another aspect which I would like to mention here. It was not talked about it in today's policy meet, but this was mentioned by the governor as well as the deputy governor, Michael Patra, about real rates. We have heard about real rate preference of 100 basis points from external members, but we still don't know the revised or reviewed view on real rates from the RBI. And last time they mentioned that they will be coming out after the GDP numbers are released. So unless we get that, I think putting 4% inflation target on a medium, on a sustainable basis, once we get clarity on monsoons plus real rate preference from the RBI, I think that will give us a lot more clarity on how the rates will evolve going forward.
Okay. Nikhil, what I really want to ask you, and I'm sure you have a sort of overall comment on the policy, but what I really want to ask you is, what does this mean, the fact that, and let's move away from MPC cycles to a government that is now going to take office. What does this mean for interest rates, particularly for consumers? And we've seen evidence manifesting in election results as well, that rural distress, the fact that two-wheeler sales tapered off, possibly on account of higher costs. Is this higher interest rate scenario going to continue to have a negative impact on consumption?
Hi, Siddharth. Thank you very much. Siddharth, broadly, I mean, we all know that the mandate for the government is not as strong as one was expecting and as it was in the last elections.
I have switched it on. I don't know why it's not.
Yeah, sorry. Okay.
Yeah, go ahead, Nikhil. Go ahead.
Right. So I was saying that yes, the mandate of the government is not as strong, and now we have a coalition government, not a very large coalition, a small coalition that we'll have as a new government. But I still do not believe that there will be a massive change in the government policies in terms of I don't think they will be preferring consumption too much over their investment-led policy that they have followed in the past decade. I mean, what we need to really understand is there are always trade-offs that are part and parcel of all economic policies. I think there is no two-way, and nobody has any doubt that the government should continue on its fiscal consolidation path. FY24 data that came out just before the elections told us that FY24 fiscal deficit was better than what the revised target was. And I think the 5.1 that they had budgeted in the interim budget for FY25, they will maintain it at 5.1% so that there is no negative surprise for the bond market or generally in financial markets. And if that is so, I still believe that they would keep broad numbers in terms of their capex outlays or borrowing number or fiscal deficit number. They will keep it broadly similar to what the interim budgeted, what they had budgeted in the interim budget. The only thing that can give them room without touching the fiscal deficit or the borrowing numbers, they could still get a room to increase their revenue spending or to increase their rural spending is one, because we know that the RBI has announced a very high dividend of more than 2 lakh crore, which is almost double of what they had budgeted. And secondly, generally we have seen that the tax collection has been very buoyant. For the last 3 to 4 consecutive years, we have seen actual receipts much more than what was budgeted. So total receipts could be revised upwards, which can allow the new government to increase their rural or non-rural revenue spending or consumption-related spending, but I don't think they will be touching their fiscal deficit or borrowing numbers. So that is for it.
Yeah, go ahead quickly. Go ahead, Nikhil.
So broadly, this is, I don't think they will be shifting away from investments. From the interest rate perspective, I don't think it would be significant enough for the RBI to cut or to hike rates. That will be broadly, since the fiscal deficit number will remain broadly unchanged.
Okay. Mr. Joshi, does the situation, and do you expect a continuing gradual fiscal consolidation or a slower pace of consolidation now?
Well, I think that we'll know once the new budget is announced. But I think my sense is that the government has been fiscally conservative for the last decade, and I think they will continue to do so. And by the way, I think the fiscal consolidation path is a very gradual one. I think if you take the 3% target, we are nowhere near it. I mean, even the next 2-3 years. So I think it was very well premeditated path for the fiscal consolidation. I think they will follow that path. I think that's my sense, because that's a very critical variable. We know that debt to GDP is India's debt to GDP is very high in the peer-rated group of similarly rated countries. So I don't think they're going to. My sense is they will not compromise fiscal consolidation for following any consumption-led strategy. I think they can figure out other ways of raising revenues. So my sense is fiscal consolidation is going to stay.
Okay. Aditi, given that there was a bonanza much larger than what had been initially factored in from the RBI, would it make sense for a certain component to be used in revenue expenditure and ensure that the momentum of growth also continues? Because while we know what happened last year and we now have a RBI projection also, all of you have also warned in the past and perhaps now about a slower momentum going forward.
Yeah, so Siddharth, the way we are looking at it, between the higher RBI dividend and our tax revenues, let's say we have a revenue upside of about 1.5 trillion, give or take. How do you split that up between revenue expenditure, capital expenditure, or let it go toward additional fiscal consolidation? So the sense I have is that in a year like this one, where we are presenting the full budget in July, and we're in the middle of the monsoons, pushing out capex in the remaining part of the year will be quite difficult. So not sure that increasing, using the additional revenue to push up the capex number further will necessarily yield us additional expenditure within this year. Some of it might end up getting unspent. So perhaps we should leave the capex target where it is for this kind of year with a curtailed implementation period. And the rest of it basically then gets split between additional revenue expenditure and additional fiscal consolidation. Now, if a big ticket scheme is announced, typically it will take about a quarter or two for it to be notified and for the beneficiaries to be found. And in a year like FY25, that will leave us again maybe 1 quarter of actual spending. So even if we have a big ticket feel good revenue expenditure scheme which gets announced, the outlay of that in FY25 itself will not end up being very huge. Most of that expenditure will get back-ended into FY26, which is why it will probably be easier to show larger fiscal consolidation this year and much harder to follow it up with incremental fiscal consolidation next year. So while we may very well be around 5% of GDP or thereabouts in FY25, still getting to 4.5% of GDP in FY26 will be a little bit challenging.
Okay. Anubhuti, coming to you and viewers, many of you must have been listening to Prime Minister Narendra Modi, who is speaking at the NDA parliamentary party meeting in Parliament, and the thing that I picked up was that from the word go really, the Prime Minister talking about a consensus and also sort of dropping hints towards a new deal and working with all the allies, and also making a pointed remark of recognizing what the mandate had meant and delivering to that. I'll stop short of over-interpreting the Prime Minister's remarks, but from my standpoint, just before I got into this discussion, I could get a sense that there is a newer sort of broad outline framework that Prime Minister Modi is hinting at. It's early days, we'll have to wait for several crucial developments, the formation of the government, the composition of the cabinet and further things, but it's clear that the budget will be a signal event to determine what Modinomics 3.0 will be all about and its consequent impact. But Anubhuti, I come back to the monetary policy framework. Was the 4:2 a surprise for you?
Sorry, can you please repeat the question?
I was saying, was the 4:2 verdict a surprise for you, Anubhuti?
Not necessarily. In fact, we always have seen Verma dissenting, Professor Verma dissenting. That was the case. That has been the case since Feb 24. While Ashima Goel is the new dove, who has emerged in the June policy meeting, her leaning towards a rate cut was pretty apparent and evident in the minutes of the last two meetings. If I just quote what she said in the April, meeting, which was very well captured in the minutes, that amidst many uncertainties, she decided to stay.
Okay, we seem to have a bad connection with Anubhuti, but she said, she used words like doves, and I was kind of thinking that maybe it's time to talk about bulls and bears in the MPC, but I won't do that here. I want to go to you, Nikhil, with a straight off question. How distant is a rate cut now in India? Nikhil, that question was for you.
We have been maintaining this for a long time. Yes, can you hear me?
Yeah, go ahead.
Right. So I'm saying to your question, we have been maintaining this for a long time, that a rate cut in India could eventually happen only in late CY24 or probably in early CY25. With today's policy, I think that kind of reinforces this belief. One point that I want to mention, Siddharth, one thing that happened in today's policy is the government explicitly mentioned, which I think has good bearing on interest rate going forward, is the governor explicitly mentioned in his statement that the RBI looks at what the US Federal Reserve is doing or other global central banks are doing, but eventually it's the domestic fundamentals which determine the monetary policy of the Reserve Bank of India. To me, coming out explicitly with such a statement is a clear indication to all who are expecting that the RBI will be following the US Federal Reserve as soon as the Fed cuts rate. I think it's clear signal that we will not be following the US Fed 1:1. That was never the case, but in order to subdue all those expectations, I think it gives a clear indication that till the time our growth is strong, till the time our inflation is not a concern, RBI may not need to cut rates, which is what our forecasts also build in. I think probably in Q4 of FY25 we could see the first rate cut in India.
Okay, Mr. Joshi, is now a new theory going to, not a new theory, but this going to gain ground that the RBI is decoupling itself from other global central banks? The ECB has already done a cut, and Bank of Canada as well. There are a couple of other banks that are also lined up. So perhaps the global rate cut cycle has begun, and is therefore RBI saying that it's not going to be in sync and will decouple?
Well, yeah, it's definitely not going to be in sync. I think if I just take you back to the pandemic, everybody cut rates to fight the pandemic. After that, there was inflation emerged, so everybody started raising rates. But the cutting of rates is very asynchronous. Countries which have policy space, like the United States, I think they are going to be higher for longer. Europe is very closely connected to United States economically, but still, I think it is not. It's not following the Fed, so to say. And the reason is because of their growth compulsion. Their growth is expected at 0.7%. So inflation is not under control, but because of growth compulsions, they have started cutting rates. And Latin America actually had started cutting rates even before anybody else did. Asia in general I think is there has been some delay in the rate cut expectation because of the Fed actions. Many of the and because the capital flow became very volatile, currencies came under pressure, so the central banks also become cautious. Now, if I put India in that, I think India's situation has been somewhat different. Its currency didn't come under pressure, and the governor said that that's because I think the fundamentals are solid, and I think it's still that gives strength to the currency, and we also have enough reserves to stabilize the currency. So I think India doesn't have the kind of compulsion which many other economies have. So I think I would like to just close by saying that there is going to be a asynchronicity in the cycle of rate cuts, and countries will respond depending on their domestic growth and inflation dynamics and their economic compulsions.
Aditi, on that very subject, what would you like to add?
So on the timing of the rate cut, if we have a completely Goldilocks situation as far as monsoon and inflation and food output is concerned, then I'm not ruling out a stance change in the August policy, although I do feel that the probability of that is quite dim. We will end up with very back-ended rate cuts this year, and in any case, in this cycle, with where growth is expected by the RBI to land, and if we are able to contain inflation at around 4.5%, in any case, I don't think this rate cut cycle is going to be very deep. 50 basis points is the maximum that we're looking at. Whether that comes in October or December, which is a small possibility, or December and let's say February, I think that's basically where most of us are veering now.
Okay.
Yeah.
Go ahead, Mr. Joshi, go ahead.
No, I just wanted to add to that we also have a forecast of 2 rate cuts this year, and probably likely to begin in October, because by that time you'll have clarity on how the rains have played out and how does the agriculture is looking like. So I think that's the earliest the rate cut can happen.
Anubhuti, what's your forecast that you're working with?
Yeah, similar forecast, Siddharth. So we are also looking at a very shallow rate cutting cycle of 50 basis points. Currently, we expect it between October and December, but there is a risk of a delay if there are certain surprises, or in case if we see global rates staying higher for longer. But as of now, it's October and December, 25 basis points each.
Nikhil, I want you to comment on the governor using pretty much tough words when it came to NBFCs, and I'll try and read that quote where he said words to the effect that it has also been observed in some microfinance institutions and NBFCs that the interest rates on small value loans are high and appear to be usurious. This statement has caught the attention of many people. How significant is it, and is there any negative consequence that you can foresee?
Siddharth, I don't think this is really significant. I mean, even if that is the case, and that is definitely the case, the governor has used it, I don't think it is very prevalent. It is ubiquitous. There would be small pockets, a few NBFCs which would have been doing this, and I'm sure the RBI would be sensitizing them to be within the guidelines of these activities. As far as negative consequences, again, if you look at value-wise, all the big NBFCs are, I think they are growing their books at a decent level. The RBI has been extremely vigilant. Interest for all these large banks, which really account for a bulk of this NBFC loan market, I think they have been extremely transparent, and this case is not very prevalent that they are charging a very high interest rate, etc. So it may be in some pockets, but I don't think this practice is prevalent. So from the national economist perspective, I don't think this is something to be worried about.
Okay, one quick question to you, Mr. Joshi. In terms of the draft circular when it comes to infrastructure finance, comments on this, can we sort of read between the lines and say that perhaps without saying it, and that was also part of the press conference today, there are some initial concerns that certain pockets might be overheating, and therefore the RBI is trying to do some early steps?
No, I think what RBI said was that there are some outliers, I think, and they are closely monitoring and supervising to check for those outliers. I think this is, so they are acting proactively, I would say.
Okay, acting proactively. Viewers, this is the first monetary policy meeting after the elections, and very clearly all attention now shifts to some of the other macro factors, the monsoon being one of them, US action and the budget being one of the most important, and all of us will perhaps now be following Delhi more than Mint Street over the next 3-4 weeks. Mr. Joshi, Aditi, Anubhuti and Nikhil, thank you very much for your time with us today, where you helped us decode the latest policy moves and also what we can expect in the coming quarters. Viewers, with that, it's time for a short break. We'll come back with continuing coverage. Do stay tuned in.
As Narendra Modi gears up to take oath for the third time as India's Prime Minister, allies in the NDA camp are already piling pressure on the BJP.